Nigeria's Sterling Bank, they recently offered to issue 3 billion new shares to acquire the privately held Equitorial Trust Bank. Shareholders of both banks have met today to approve this deal. This follows failed talks between Sterling Bank and South Africa's First Strand. That was last year. Wole Famurewa has more on the details of the acquisition. He's standing by. Wole.
Yeah, thanks, Lorato. As you know, all of this week, Nigerian banks are considering deals, or shareholders of those banks are considering deals for rescued banks and for M&A transactions. The latest, of course, is Sterling Bank, and that deal, as you mentioned, with ETB seems to be on course as shareholders have approved those transactions. Joining me in the studio to take a look at that deal is Yemi Odubiyi, who is the Chief Strategist at Sterling Bank. Thanks a lot, Yemi, for joining us on the show today.
Wole.
First of all, let's get, if you can just highlight for us, also for the benefit of our viewers, the key highlights, or should I say the dynamics of this deal in terms of how ETB becomes a part of Sterling.
All right. The first step that occurs is AMCON, the local bad bank, in inverted commas. AMCON will infuse capital into ETB to take the capital to zero from the negative of 65 billion or so. That is the current position. AMCON has done that today. We have confirmation of that. After that capital injection, ETB shareholders will then inject another amount of money, in this case 8.5 billion naira, to take ETB into positive equity. Now, Sterling is then going to assume the assets and liabilities of ETB post this capital infusion. So in terms of stages and steps, those are the steps that will occur for ETB to become a part of Sterling Bank. Our expectation is that at 8.5 billion naira for the current capital, for the current value of assets within ETB, that will cover its capital requirements, and then we will merge that business into Sterling.
And I hear that post the merger, ETB shareholders will own about 20% of.
That's correct. We'll be issued about
entity.
3.14 billion shares to ETB, and that will be in consideration for the assets and liabilities and for the positive equity of 8.5 billion.
Okay, let's talk a bit about why this deal makes sense for shareholders right now. Obviously, we know Sterling Bank was open to talks with First Strand recently for a deal. Clearly, you've moved on from that, and now you've come into this transaction. We know it's going to move you closer to the top tier of Nigerian banks. In fact, many will argue that you're on the higher cadre of the tier 2 banks right now. But what exactly are you looking to extract from this transaction for shareholders?
There are a couple of benefits we see. The history of Sterling, as you already know, is one that is deeply immersed in investment banking. When we created Sterling in 2006, 4 of the 5 legacy components were merchant banks. So we've been trying to transform our business into a proper retail banking business. So what we anticipate with this is a number of benefits. One, we believe the transaction almost doubles our existing retail customer base. Our retail customer base active accounts is about 500,000, and ETB currently has about 350,000 clients that we will be assuming immediately upon completion. Other than customers, the deposit book of ETB is currently at about 2/3 of the Sterling deposit book, and that benefit comes on board immediately as well. So apart from deposits and customers, there's the added benefit of branches. Sterling operates out of 97 locations currently. ETB has 92 or so operational branches and another 60 or so work-in-progress branches, so labeled because they've been started but not completed because of the capital situation in ETB. So we get the immediate benefit of customers, deposits, and in addition to customers and deposits, we get the added benefit of improved branches. Clearly, this transaction makes us a stronger retail proposition than was hitherto the case.
So it seems the focus going forward clearly is retail for Sterling?
We think the opportunity in retail is significant because the middle class in Nigeria is expanding. We see significant benefits to be assumed from that, and we're clearly positioning our brand to be able to take advantage of those.
Okay, but some might argue that how sensible is this deal in the context of the fears that, or the global concerns about a recession and the impact that could have on the Nigerian economy, obviously from the impact it might have on the oil price. Is this a good time to do a deal, given all that we know could happen?
Our view is that if you look at current market valuations, the deal has closed at a level that is very beneficial to sterling shareholders. It references the book rather than the current market price. So obviously, it's fairly valued for sterling shareholders. That's the first argument for a deal. Now, talking about global headwinds, the reality is this: the headwinds don't change whether or not you're in an M&A, right? So global headwinds will be there irrespective of whether you're in a transaction. The key there is, are you in a position to strengthen your business irrespective of what emerges out of that situation? But I think, still talking about integration and execution, the key element here is, do we have the capability as a management team to execute a deal like this? I'll draw your attention to the fact that the history of sterling is one of M&A, going back to 2006 and a 5-way merger to create sterling itself. So we have proven capability to integrate in a very short time space an entity like this, certainly one of ETB's scale. So we believe that execution capabilities make this meaningful for us. It improves our strategic position within the market, and overall we think the risks are manageable.
Well, the market obviously will be watching, and analysts will be watching very closely. Thank you so much for joining us. Yemi Odubiyi, Chief Strategist at Sterling Bank, giving us his thoughts on the Sterling Bank ETB merger, which should happen hopefully in another few months. Is back to you, Lorato.